How can socially conscious people like us, how can we fix our broken financial system that currently favors big banks, traditional corporations, and the super rich to a system that looks out for the well-being of us average American citizens without using politicians or regulations? This is the question we ask on the Crowd Effect podcast. I am your host, Paul Lovejoy, activist investment advisor at Stakeholder Enterprise. Today is part two of a two-part series of how our banking system will eventually collapse. So, a quick summary of yesterday's episode. I talked about this vicious cycle that for profit publicly traded banks are in. They are under this enormous pressure to increase their profits every quarter. And because of this pressure, they cut corners, commit fraud, and which results in regulations because we can't have that happening. Then the banks, because of these regulations, it's more expensive for them to operate. So now they're under even more pressure to figure out new ways to increase their profits, which leads to abusing their customers and which causes more regulations, which makes it even more expensive for banks to operate. And now they're offering customers toxic securities and so forth. So this cycle is just unsustainable. And at some point, it just won't last. Banks won't be profitable, which will eventually lead to stock market price declines, and which banks are fundamentally the foundation of the entire stock market, which could lead to a complete economic collapse. And a lot of retirement investors are shareholders in these banks. So this is a big problem now, and that's what I talked about yesterday, and how credit unions are a great way to put your money when you need banking services. So that's just part of the solution and part of the problem. Um, I also touched on concentration of wealth, and this what's happening now. Billions and tens of billions of dollars are going from regional banks to big banks, which is concentrating wealth and power even more, which leads to this too big to fail problem. So yeah, we're in a bad situation here with our banking system. But again, this is just part of the problem that I talked about. Silicon Valley Bank, their board of directors, 12 out of the 12 board of directors, seven of them had Stanford degrees, and most of them were MBAs, Masters of Business Administration. So you have a lack of diversity of opinion. So there isn't any outside the box thinking. Most of them are saying, okay, yeah, this is what we need to do, and it further concentrates this power. The other huge issue is finding a balance that we can continue our economic growth, uh, but at the same time, not have it rely on our current banking system, because it does right now. So, uh, economic growth is, economists use something called GDP. You're probably familiar with it, gross domestic product. It's it's how we grade or rate our economy in our country. And when GDP is up, things are good. When GDP is down, recession, so forth. So, how do they get GDP? It's actually quite easy. A very simple formula. It's money supply times the velocity of money. Velocity of money is actually kind of an easy concept. It's the rate in which transactions happen. So let's say John the baker, he sells a dozen muffins, and they're hugely popular. These muffins, delicious. With the profits he makes from selling the muffins, he buys supplies, flour, eggs, and so forth, um, and enough supply for 2 dozen. And so now he sells these 2 dozen just as quickly as he did the first dozen originally, and so the velocity of money is increasing, and now he goes and buys enough supply for 4 dozen, and then the suppliers who are supplying him with the flour and the eggs, or so forth, the same thing's happening with them. So that's velocity of money. The second thing is money supply, and this is where our banking system comes into play. So banks, they increase the supply of money, they create money. Essentially, some estimates range as high as 97% of all money that's created is through our commercial banking system. So, commercial banks, they create money anytime they issue a loan. So, and they're allowed to issue loans based on the deposit of account holders. So, if a bank has $100 billion in deposits, then they're allowed to issue loans based on that amount. Now, this is called fractional reserve lending. So, the Fed steps in and say, okay, you can loan up to 90% of your deposits. So if a bank has 100 billion, then they're allowed to loan 90 billion. And that 90 billion is created. It doesn't, no one's deposits, no one's accounts, banks are tanking that. Imagine how you would feel if all of a sudden the bank actually used your money in your account to issue these loans. No, that doesn't happen. The money is created to issue loans, and this increases the supply of money. So when you get a loan, what do you do with that money? Well, oftentimes you just put it into a bank, which now increases the bank's ability to loan. So this is how money is created, and the money supply is increased. Now, in moderation, this is a good thing because it does increase economic growth. More people, the pie, the size of the pie increases, allowing more opportunity. But that's not often the case. Often banks are loaning to exploitive companies and projects, and which keep wages low and so forth. So that in theory it's supposed to be great, but in actuality, the rich are getting richer, and the middle class is shrinking, and it's a problem. So money supply. Now, the Fed, they currently, they're the ones that set the limits on banks on how much money they can loan. All right, that number right now, the reserve requirement is 0%. So if they have $100 billion in deposits on account holders, they're legally allowed to loan money up to $100 billion. Now, this is a problem. Um, because of this, Silicon Valley Bank, they didn't have any reserve requirement to handle this run, this bank run, classic bank run where people are scrambling to take money out of their account. There's the reserve requirement is 0%, zero. So they didn't have that. Now, if the Fed all of a sudden decides to raise the reserve requirement, well, what happens? Well, this is going to stunt economic growth because now the money supply isn't going to increase at the same rate. On top of that, there are high interest rates already, which is supposed to decrease the money supply. So it would be a double whammy effect of having higher interest rates, so less people are borrowing money, and then less money supply, which would even further decline. So that would be like a death blow for our economy, just absolutely crippling our ability to grow. So we can't. So we're stuck in this catch 22. Well, banks don't have the ability to cover bank runs right now. No bank does. None. Not even Bank of America has the ability to cover a bank run if it was as severe as the Silicon Valley one. I also talked about how banks have, uh, uh, hundreds of thousands of loans, maybe more of loans that have lower interest rates than what our current inflation rate is. So if they had to sell these loans, they'd have to sell them at a discount, which would that's what happened to Silicon Valley Bank. So we're in a really, really horrible situation where we can't raise the reserve requirement because it's going to kill economic growth. And so the our system is built on this house of cards, so very delicate. So much depends on these banks. This concentration of wealth and power, concentration of wealth and power, and who gets the short end of the stick? Who gets screwed in the end? Well, it's not the big banks. Remember in 2008, these banking officials, they were getting golden parachutes. Now there is some regulations now and laws that were passed that will hold some of these executives accountable, but it's very difficult to prove. We just saw that Silicon Valley Bank, the CEO, the president, he sold millions of dollars of shares in his bank in January. To me, it looks like he saw the writing on the wall that his bank was definitely going to fail. So he wanted to get out quickly as possible. And he claims, oh, no, this is for estate planning or whatever. The same thing with the bank that in Boston that got bailed out by the big banks. He sold $4 million worth of shares in his. These guys saw the writing on the wall. This is just my opinion and how it appears. I don't know if this is the case for sure. Maybe it is estate planning that all of a sudden they sold these shares a few months before this. But it's incredibly difficult to prove. How can you prove that? I mean, they are older, these people who are running these banks, so it is plausible that it is for estate planning and such. So it's very difficult to prove. So it's hard to hold these banking executives accountable. You need to have a smoking gun, and people are getting smarter and not putting stuff down in writing. In these emails. Some people aren't, and those are the people who get caught. The ones who are a little bit smarter and say, "Okay, I'm not going to put anything down," they're not getting caught. Okay, so what is the solution? What can we do? All right, what we need is to decentralize the power of these banks. That's number one. Number two, we need to have a diverse set of opinions on where the funding goes. Right now, there isn't. It's MBAs, coming from these elite schools. They're the ones that are currently saying, okay, this is where money goes. Well, it's not a diverse opinion. Um, we need a large set of diverse opinions. It's got to be decentralized. And number three, it needs to be independent. We can't have, someone over, hanging over our head saying you need to do this. We have to have independent. It has to be free, decided between each individual of what happens and where it goes. Okay. Now I'm not talking about crypto here. Uh, Crypto is a whole nother story. And I guess the problem with crypto is that if I asked you how much is a dollar worth, you probably say, well, what someone would, pay for a good or service for. Yeah, that's what a dollar's worth. But if I asked you what is Bitcoin's worth, you would probably say, oh, one Bitcoin's worth $4,000. You wouldn't say, well, whatever someone would pay a good in service for Bitcoin. So it's just not there. We don't see it as money yet. Um, and maybe someday in the future, I think for sure someday in the future, uh, crypto will be a source of money. We're not there yet. I can't tell you if it's going to be 10, 20, 100, 200 years from now when it will be. And will it be Bitcoin? Will it be some other one? It's kind of like trying to guess which social media site in the early 2000s was going to happen. Is it going to be Facebook? Is it going to be MySpace? So crypto, This isn't the solution. It's too big of a problem for crypto to solve. Okay, so decentralized, diverse opinion, independent. Um, what are we going to do? Well, fortunately, through technology and through a change in our laws in 2015, um, the private market was opened up to the general public. Okay, so what's the private market? The private market is where foundational wealth is built. It's where the rules of our economic markets are made. This is how we develop systems and structures for our financial markets. This is where we develop our corporations. It happens in the private market. And who gets to invest in the private market? Well, not a diverse set of opinion. Only 2% of US income earners, all right, these are called accredited investors. Only 2%. 98% of the US population is locked out of US income earners. 98% of US income earners, people who aren't making income, you know, they're, locked out obviously as well. But in 2015, this changed. It happened. The general public is allowed to invest in the private market via crowdfunding. So, so this had completely changed the rules of the game. Um, and and in order to have this independent, diverse opinion, decentralized, we need all 257 million adults in this country to be the banking system, to be the banking system. What does that mean? Well, there's something called crowd lending. It's instead of uh, getting a loan from a bank, you can go to a crowd lending platform that offers a medium where uh, where consumers can borrow money directly from regular people. It's called peer-to-peer lending. And this does a number of things. It All of a sudden you have this diverse opinions going on of who gets money and who doesn't. So I think this person should get loan, this company should get loan. Maybe you think someone else should get this loan and someone else should get this money. And that's a good thing. It's decentralized. No one's saying, "Oh, okay." There is no like. I'm not getting all the wealth from it, like a bank does. We're all getting wealth from it. It's independent. There's no there's no there's no governing body saying that this is what needs to happen. You're free to loan whoever you want to loan because you have these diverse opinions and you have the ability to go ahead and loan money out. You can do however you see fit. There's no reserve requirement going on. It's a market based redistribution of wealth. At this point, we have all the technology, we have even the laws. We don't need politicians or regulations at this point. There's no pressure for me to meet a quarterly earnings report. I don't have to be like, oh, I have shareholders who want the increase in the share of their stock. I don't have that problem. I don't have this pressure to cut corners. I could loan money to regenerative agriculture farms. I could loan money to communities. I can loan money to just regular people who are looking to um, consolidate their debt and give them a lower monthly payment. And that's just the tip of the iceberg. Um, Through crowd lending, we have the ability to actually be the change, and there's no conflict that happens. And now when the people become crowd lending, now guess what? We are no longer reacting to the market. We're not like scrambling to take money out of one bank and putting into another. Instead, we're being proactive. And when we are proactive, the market now has to react to us. And when a market has to react to us, now they're now needing to put more crowd lending platforms and to offer more loans to people that we want to lend to companies that we want to lend to communities that we want to lend to. The market now has to react to us, and this is why I love crowd investing, and it does redistribute wealth, but it also redistributes power in the same way of not one person or a few select MBAs from elite schools get to decide where the money goes. It's up to us. We now have that power. My name is Paul Lovejoy. I am a crowd investor, and I see you are one too. If you'd like to know how to reform our unjust financial system legally, ethically, and without confrontation, go to stakeholderenterprise.com.